Yeah. In returns, interest earned on a cash deposit clearly represent the return. It is important to ensure that the rates that are being compared are calculated on the same basis and take account of any charges, impact of taxation, etc. Yeah, so then say tax is involved. So then basically banks or any other particular borrowers uh, refer or rather call it the gross terms. So then you need to check whether what is the interest rate impact on what is my net of tax return. So then you need to calculate in that way. Give me right. Returns earned on a cash deposit clearly represent the return. It is important to ensure that the rates that are being compared are calculated on the same basis and take account of any charges, impact of taxation. So yeah, withholding tax, and then you can calculate your net of tax return. So that's the real return that you get it. So then it's up to you to just see whether what is the real return, adjusting those tax impacts and any other charges available. Returns are competing accounts require close inspection as advertised rates do not always represent the true rate actually earned. Yeah, so then you need to basically compare it, right? Compare with other investment products, and you have to ensure whether these advertised rates are the real returns that you get it. Tax treatment may vary and the rates may be quoted on net or gross of tax, right? So they usually they advertise on a gross rate. So then it's up to you to understand what's your net rate. There may be penalty charges if withdrawals are made or early encashment is needed, which will reduce returns. Yes, so then if you all premature withdraw that you will lose money. But if you look at a money market fund, there's no such kind of a charge being done because 1 day prior notice that the liquidity is given. That's why that is the major difference between the bank deposit and the money market fund. High court returns may only last for a limited period to be replaced by lower rates. Yeah, now if you look at the current day scenario, guys, now if you have invested in a money market fund, I'm referring to money market fund because that's a very kind of a typical example for this money market instruments. Money market fund, you were enjoying around 25%, 26% return, right? Because what they have been doing, bulk of the funds are invested in the treasury bills and the securitized papers, commercial papers, etc. And FDs, so right, FDs also carry a maybe higher rate so far, and even the treasury bills were at 30% rate, right? So if they have locked their money for a short term, maybe 6 month to 1 year period, so then during that particular time period, money market investors are getting a better interest on top of that because fund is yielding at a better rates. But if we look at now, rates drop down. So what happens is, if the funds investments are going to be matured within the next 3 months, right? Say then we have invested in a commercial paper, you have invested in securitized paper. So now after another 6 month time, those investments are now matured, right? And what happens is, then we'll say treasury bills, then it matured. So then what happens is you need to reinvest it. But when it go to reinvest, can you invest in products or instruments which will give you around 20% or 25% again? The answer is no. Don't have that much, larger rates available in any given product by that time. So you have to invest in products where that carries a relatively low interest rate than 6 months before, right? So then if you put a FD, you'll be getting only 12 to 14%. And if you put a 1 year treasury bill, you'll be getting a 16.9%. And if you invest in the commercial paper too, yeah, that rate's also adjusted downward along with the market interest rates. You will not be getting any 20 or 20 plus returns. And if you invest in securitized paper too, that paper doesn't carry that much, interest rate. So now your money market funds return will drop down, and thereby your returns also will be drop down along with the lower rates now, lower rates. So then that will be more of a, go in line with the interest rate cycle. So high quoted returns may only last for a limited period to be replaced by lower rates. That's what happened. The interest rates on an account is often referred to as the nominal rate. And the annualized rate allowing for the frequency which interest is paid is referred to as the annual equivalent rate or effective rate. Yes. So now we'll say if you are quoting a nominal interest rate, say it's now say assuming I'll take typical example that you all very much familiar to you guys, FD rate. Some FDs are I think monthly interest are paid, right? Some FDs are there, say half yearly interest are paid. So then, but if you quote the FD rate for a 1 year, that's a nominal rate. Say it's 15%. But when interest are paid maybe monthly, right? Monthly. If you want to reinvest that, say whatever monthly interest rate also, then there would be say 12 times compounding happen, no? So 1 month, then you reinvest for another rest of the month. Second month, reinvest. Likewise, your interest will also be reinvested and compounded. So then if you look at it in that way, your real return would be, your effective return would be much larger than your flat rate or a nominal rate, right? So the difference or the relationship between the nominal rate and this AER, or in other words, effective rate, would be higher the frequency of your compounding or reinvestment, then you may get a higher return than your nominal rate. Because that obvious, not the 1 year will say you get the first month interest and you will be reinvesting it again, maybe at the same rate, right? And the second month interest will be reinvested the same rate. Third month, reinvest the same rate. Yeah. FD will, you can withdraw the money. That's true. But the assumption is if you use that interest to be reinvested for another 10 months, you get the second month interest and reinvested the rest 10 months. Likewise, it goes, see your interest on interest come into play, and that will, increase your interest rate, or rather your return. So that's the thing. So if you have to understand what is nominal rate and what the effective rate. So the difference is, say 1 year FD, yearly interest payment. So then you don't want to be worried because your nominal rate equal to your AER or effective rate, because one time you will be getting interest. So there's no chance for you to reinvest it again. This happens is within a 1 year period, if there are multiple times of compounding or the reinvestment happens, so then that will be compounding, right? So more the frequency that you pay interest or you get interest, higher compounding, and that will lead your AER or effective rate to go up. So this is the interest rate on an account is often referred to as nominal rate, and the annualized rate allowing for the frequency which interest is paid is referred to as the annual equivalent rate or the effective rate. There's a small calculation here. The effective annual rate can be calculating using the following, using the formula shown below. Annual equivalent rate equal 1 plus R to the power n. And minus 1 should also be showing here. So I think that will be tackled in the latter part of the description. The letter R in the formula simply refers to the nominal rate of interest, and the letter N refers to the number of period in which interest will be paid. So now, assuming assuming now, say example, if I investing in a bond, that bond carries a coupon rate of say 10%, and that bond give or rather pay you interest or the coupon in four installments, or rather we'll say 4 times per year, right? Every quarter in that context. So then you have to, your R would be 10%. R means your nominal rate, that would be 10%. So N would be how much the frequency happens, four times. But here the R that you have to put it in this form, because when your annual is 10%. So then your quarterly rate would be 10 divided by 10% divided by 4. That means 2.5%. So your R would be 2.5%, but your N would be 4 times, right? Because 4 compounding or other frequencies there. So then, of course, you get the annual equivalent rate. So that's a very important thing when you compare with the investment products, because when there is this reinvestment or other number of frequencies happen in interest payment, then you need to take into consideration this AER. The letter R in the formula simply refers to the nominal rate of interest, and the letter N refers to the number of periods in which interest will be paid. For example, if a bank offers an instant access account with an advertised rate of 3%, so that advertised rate is then this is the nominal rate, which is credited quarterly, right? So the interest will be paid quarterly, right? I think you guys are well familiar with FDs. FDs are also paying maybe quarterly to half yearly or monthly, etc. So number of times compounding happen, frequencies there. So the AER for the account can be calculated using this formula by, firstly, work out the rate of interest being paid. In this example, 3% per annum, but is paid quarterly. The nominal rate is 3%, but is paid quarterly. That means 4 times per year, right? So therefore, need to divide the annual rate by the number of periods. So the annual rate is 3%, but when we plug into the formula, R would be dependent on the number of times that you pay interest. So if it's 4, then the nominal interest rate per annum should be divided by 4. If the frequency of paying interest is 6, or rather say 12 months, or in the monthly basis, so that means 12 times. So then your nominal rate divided by 12. That is called R. So in this example, 3% need to be divided by 4. Why? Every quarterly interest is paid. So then means 4 times your interest are paid 4 times per year. So what happens? 3% divided by 4 means 0.75. The result is converted into a decimal to give 0.0075. Right. Then you plug into your formula 1 plus R. So then 1 plus R that you already calculated, 0.75. Right. Now to the power N. What is N? N means 4 times. N means number of times, 4 times, no? 4 times that you pay interest. So this then multiplied to the power of R, the number of periods, to the power of 4 equal 1.0339, right? This is then converted into the percentage written by deducting 1 and expressing the number of as a percentage. Yeah, I'll go to the Excel and just do this thing. Guys, can you all see my Excel?
Not yet, sir.
Not yet, no. Wait.
It's online.
Now you all can see, right?
Yeah.
Right. So just nominal interest rate. Nominal interest rate is say 10%, right? And then the interest payment frequency, say 4 times, right? That means every quarter. So then what happens is formula says 1 plus r, right? And to the power n, to the power n, okay? Sorry. To the power n. So then, of course, we are talking about r means 10% divided by 4, right? This is the interest payment frequency. That means 0.025. Okay. So then I will rewrite this formula as 1 plus this, okay, and to the power r to the power 4. So then I got the value 1.03. So then I will deduct. I'll deduct. So then if I rewrite this formula, I think that then better you can remember, right? Then minus 1, right? Minus 1. So then you need to deduct 1 here. Then if I put in here minus 1 gives you this value. So if I convert into the percentage term, 10.38. So 10.38 would be our AER. Right, 10.38 would be our AER. So then in a nominal interest at 10%, but since the frequency is high, it becomes 10.38. So now think about frequencies, say every month you pay the interest. So that means 12 times, no? 12 times. If I just change this 12 times, then what happens is here 10.47, 10.47, right? So you can see more the frequency of your compounding, right? More the frequency that you pay interest. So that means compounding, then your AER is higher. AER is higher, right? So now what is the assumption? Whatever the interest that you earn every time that you reinvest the same rate, right? So in that context, your AER would be higher. So then if this is 6, say 6, 10.43, and if it's 4, 10.38, right? So then more the frequency, I'll rewrite more the frequency of paying interest, higher the AER, right? Going back, can you see my PPT?
Yes.
Yeah.
Right, okay. So this is how your AER is calculated. Right. Cash investments are relatively simple products. However, attached is with the default risk of the financial institute. Yes, if you look at now, even the money market funds, right? So then you invest in a money market fund, but money that fund will invest in certain products, money market products, below 1 year products. So we say securitized papers, say commercial papers. Securitized papers anyway, it's bit of they have a recourse because you can sell the mortgage assets or vehicles, so then you can pay it off. But commercial papers are the problem. Here there's no security, it's unsecured, and then it's solely on top of the strength of the issuer or the borrowing company. If the cash flows are quite sound in that company, then you will be paid on that. But if you are if you have invested in a commercial paper of a company where the cash flow is not quite sound, then the issue is then there would be a default risk is there. So
Do the issuer need to get a rating on that? Is it a must?
yeah,
The law?
actually, is it a must in a
Okay.
sense? Because if you look at a commercial paper, those are happening in the private markets, right?
Yeah.
So in the private markets, you can issue now. We'll say you are from, say, a company, say ACL cables, example, right? ACL cables. Now you want to raise 6 months, right? But you haven't rated. You haven't got a rated.
Yeah.
But depending on the cash flows, we'll say if you analyze, we'll say I'm the investor, so I'll analyze the balance sheet, the P&L, and the cash flow, and I understand the cash flows are quite okay. So then for a 6-month time frame that I'll be able to get a exposure here. But since it is not rated, I can ask, look, I'll be investing in a bit of a relatively high interest rate, right? So then if they are in urgency of a cash, SEL, so then they probably may go ahead. But if they want to have a better kind of a rate to get quoted, they probably get a rating. If that rating then sounds good, so then you can get a quote from few companies or few investors. So then you will get a best rate to borrow, right? It's not a mandatory as such, but it is a norm where you need to get a rating for you to get the best rate. Otherwise, investors are not, trying to get the maximum. Okay, I'm willing to invest, but I need this rate. But if you are rated, then there is some kind of platform for you to rather decide your borrowing rate. Understood?
Yes, sir.
But there's no mandatory thing. But there's a norm. If you want to go for commercial papers, now say example, funds, say, assuming money market funds, say NDB Well, or maybe normal, or maybe some other money market funds also investing in commercial paper. No, but for you to go ahead and ask the money market fund to invest, they only invest in rated instruments, right? So then as a issuer, you can't forget that rating because you need to get that rating because investment mandate of those funds will carry and then they invest only on rated instruments.
Yeah,
so if you
because
want to,
they assure the rating, it's like that.
Yeah.
So they cannot bargain on rate.
No, of course, because now say the money market funds per se, they have an investment mandate with the clients of it because you and me are investing in the money market fund, right? So we should have assurance where the money market fund will invest in the right instrument and they will balance the risk and return. So then they have a mandate saying that, look, we are investing only rated instruments above investment grading, BBB minus. So then we are, as investors, we are very much, comfortable because then they know what their investment mandate are. So then I will put you and put money to the money market fund. So then the money market fund goes and invest in the commercial paper. Say they might invest in the LOLC commercial paper. LOLC has issued the commercial paper to raise funds for them and say assuming the money market fund has invested there. That return will say rating would be, I don't know, say double B. Double B. And then another company, say BBB minus, that's a bit of a lower, the last investment grading also issued a commercial paper. So these guys have invested there. So their return is a bit of a higher than the LOLC then, right? So likewise, they invest only on the rated instruments. So if an unrated company come and ask, yes, issue a paper, they never invest there because that's basically violation of the investment mandate. So if you want to approach or rather get accessible to a wider spectrum of investors, it's a norm for you to have your instrument rated. Otherwise, you will be getting only a small portion of the investors. Sometimes you need to pay high interest rate for them then because you're not rated, right?
Yes.
So yes, it's not mandatory, but that's a norm. You need to get it rated for you to get the best rate and to get the traction of the wider investors, including the money market fund to other, institutional funds.
All right, sir.
So this rating is same as the listed companies rating in the stock market. Or is it different? Right.
No. Same methodology, same procedure. Now there are two rating agencies in Sri Lanka, no? Fitch Rating.
Yes.
Another one is ICRA, no? ICRA. ICRA, is it close? Oh, S&P is there, no? Yeah, I think
S&P is there. S&P
S&P
is
there. Yeah, so ICRA, I think you close the operation, I guess, no?
Is it only the listed companies that can raise commercial papers, or is it others?
No.
Anybody?
That's not hard and
Private.
fast. So any given company,
Okay.
you can raise. So then if you are rated, there are private companies who are rated. So they're not only listed entities. So then we'll say if a private company, unlisted space, still you can go to the Fitch and say, I need to get a rating. So the Fitch will rate it, but which is not published. Because that's a private rating. Right? So now if you look at a listed entities only, because this listed entity use that because then they will publish this thing, and because they get the traction, so then of course they get the traction of the investors. But if you are a unlisted entity, so you will raise commercial paper or any other securitized paper privately. So you don't want to publish that, right? So, but still they are rated. They get the rating because rating will cost you. So then you go to the Fitch Rating and pay some, their rating fee and get it rated. So that is not published. That in private space, they will use that one if they want to raise a commercial paper. So then put a commercial paper, and they approach this, say money market fund or whatever. Some money market funds are having that mandate saying that we are only investing in the listed companies. Some are okay. That again depends on the fund. So then, yes, to answer your question, even a private company can get a rating, and they can raise commercial papers or either securitized papers or whatever.
Okay.
Yeah. Yes, cash investment are relatively simple products, however, attached with the default risk of the financial institute. Yes, default risk is anyway there. Right? So that's why rating will suggest you how stable the company is. Some of the risk, deposit taking institutions are of varying credit worthiness, and any default risk must be assessed. Yeah, even banks, I think you have varied credit ratings, and based on that, the default risk that we can assess. So the credit rating would be a better way of assessing your default risk that gives you the understanding of how sound the bank or a financial institution is standing on. Inflation reduces the return and could mean the real return after tax is negative. Yeah, now if you look at the current day scenario, guys, now the inflation is coming down. But if you look at the interest rates, inflation was around 60%, 70%. And in that context, you are getting 30% on your treasury bill. Still, you can't say it's a good investment, right? Because you're purchasing, it's a negative interest rates, negative real return, right? Negative real, you end up with a negative real return of, 40%. So on the other hand, you are getting 30% interest, but on the other hand, you are paying 70% more to purchase goods and services. So then you haven't earned anything end of the day. So you end up with negative real return. So that's the thing. So even with this, say, fixed income securities, or even with this money market, these fixed rate instruments are having this drawback because you can't beat the inflation, and sometimes you end up with negative real return. But now, of course, things are a bit dragging down. Now, the inflation is somewhere, stabilized at 20%. And I guess I saw a few research reports, they're expecting by the year end inflation to be somewhere around 9%. So in that context, if you still can earn around, say, deposit 15% means something, better. Yeah, that positive real return will be there. But if you look at the last 12 months across, you were experiencing a negative real return, right? Which is very, very, very much not conducive for the investment point of view. Interest rates change, and so the returns from cash deposits will vary. Yeah, now we'll say if those are, I think how often the savings account saving rates are adjusted with the rates changes.
It's there's no proper mandate to the adjustments actually.
Hmm.
You mean this interest rates, so isn't it? Over the interest paying tenors.
No, I mean the savings account now anyway, somewhere around savings accounts are paid around 4 to 5%, right?
No, it's 2.5 to 2.
Yeah, but did it was it changed with, along with the interest rate?
Yes.
When
No, the savings usually doesn't change much, but
okay.
yeah, but with the higher drop or maybe a hike in the rate, it might, but for a long time it didn't.
Okay. Yeah, but other instruments are changing. No? Sorry, someone tried to tell something.
Yes, sir. Because of the low cost deposit being very attractive to the banks, usually the banks do not change the savings rates.
Okay.
They are almost kept constant, unlike the
Right.
other.
I think that's the reason where the most of your CASAs actually went towards these money market funds during last 1 year with the
Absolutely, yes.
rates were high, but no point keeping it saving account. So then transferring funds to for a short term, liquidity purposes. Two
Yeah.
options: either you put into 3 months deposit or a 6-month deposit. But at the same time, you have a sort of a penalty if you want to premature withdraw that thing. So then obviously the people or the depositors may put the money into money market funds where you have the liquidity advantage and further that you enjoy the higher interest rates as well. Huh?
Yeah.
Yes,
So,
that's true.
yeah, I think you did you see that change? Your saving and all these CASA mix was really diminishing during the last 1 year.
Actually, I don't have the figures to like either prove you or not, but savings rates have been constant right throughout.
Saving
That has
rates have
been-
been constant for like I think more than 5 years now. Previous it changed maybe 5 years ago, as I remember, but the other rates are constantly changed in this scenario. But earlier it was not like that. The central bank was not regularly increasing or decreasing the rates, but over when you think about last 1.5 years, it changed regularly and up to now.
Right. Okay.
So the banks are having a minimum amount that you have to have in a money market account. It's not a small amount. You have to have a big amount.
Money market, from a bank's point of view, money market means so
They also have money market account, some banks.
okay.
They
So
pay a higher rate.
right. Okay, what is the minimum
About 5
amount?
lakhs in some the bank that I'm banking with, 5 lakhs, and they paid earlier it was about 15%. Now it should have come down because based on the central bank rates. So now it must be lower, maybe around 12%.
Okay, so now say if you park the money in a bank money market,
Yes.
how the liquidity? Can I withdraw money?
It's like a savings. You can take any time. The moment you withdraw more, so that your balance comes below 5 lakhs, then you get back to that 2.5% normal savings rate.
Right.
So if you have maintained that 5 lakhs and above, you get that 13% or whatever. So you don't have to separately go to a money market fund. You can just even in the bank, you can do that.
And the rates
right.
are changing also. The rates are
They must be investing in those instruments elsewhere. The bank must be putting in the treasury bills and
Right, bank itself invest in certain
investing.
products.
Yeah, that's right. They don't say where they invest, and we don't have any say on which instrument they should invest, but they give you a good rate.
Okay. So then there's no separate account as such. Your saving account will be
No,
upgraded.
there's a separate money market account. Actually, they want us to open a separate money market account, and so you transfer money from your normal savings to that and try to maintain the 5 lakhs minimum.
Right. So then there is some level of certainty to the bank's point of view that you keep the money for some time with this minimum.
That's right.
Minimum threshold. So then they can easily park that money into a bit of a medium term instruments and get a better high rate.
Yes, yes.
That's the thing. Yeah, true. So if you want to say within that say 500,000 limit that you can withdraw at any point, no?
You can withdraw any amount. The only thing is once you go below 5 lakhs, then you drop to that 2.5% rate. Normal savings.
Unless the fund value is maintained above the minimum threshold amount, they only give the rate.
You don't get that rate.
Weekly changing.
Clear. Great. And now banks are having these say repo accounts also, no? So then that with the high liquidity. So we want to withdraw, we can withdraw. I think I can remember the place where I worked before that we used to keep the money at the repo accounts for our short-term liquid cash. So then and there we can, withdraw for our reasons. So then that is not this money market that you're talking about, no?
No, it's a new introduced for savers who were actually they were worried that people are withdrawing the money and going to other high-paying deposits. No, so to keep them there at the low-cost funds, they introduced this recently. Not recently, say when the interest rates went up last year, or so they introduced this.
Right. Okay. As an alternative. Okay.
Yes.
Great. Right. Currency fluctuations and different regulatory regimes where funds are invested offshore present further risk. Yeah. So then you will be exposing into the currency risk and the repatriation, etc. if you invest in offshore. As a result, when comparing available investment options, it is important to consider the risk that exists as well as compare the interest rates available. Yeah, so then the whole discussion is all about the risk and reward comparison. So then if you look at rates per se, you should know about the gross rate to net rate to AER nominal rates. So those are kind of things that you need to compare it. At the same time, it has to be compared with the underlying risk. Deposit insurance. This is a measure implemented in many countries to protect bank depositors in full or in part from losses caused by banks' inability to pay debts when due. Yes, I think in Sri Lanka also there's deposit insurance schemes available. I think I don't know exactly what the amount here. Yeah, the purpose of deposit insurance varies, but typically involves promoting financial stability and protecting small savers from loss in the case of troubled or failing back. I think this was really implemented this after 2009, this financial crisis, where this requirement was globally implemented. For example, Federal Deposit Insurance Corporation, FDIC in the US, provides insurance cover for all deposit accounts, money market deposit accounts, and certificate of deposits. The standard insurance amount is $250,000 per depositor for insured bank for each account ownership category. Yeah, so this is the minimum limit, 250,000 per depositor. So up to that particular amount, then depositors are safeguarded. So guys, any idea about the Sri Lankan context? What is the deposit insurance scheme? What is the?
It's 1.1 million, sir. Earlier it was 6 lakhs. Now it's 1.1.
Right. So that means that assumes we'll say if you hold any amount, but up to 1.1 million, you are paid by this through the insurance, no?
Yeah. Yes.
Right. Okay. So then a small depositors, the whole idea is to safeguard the small depositors. So across the European Union, an EU directive required member states to have deposit guarantee schemes for the first 100% of deposits up to 100,000. So up to 100,000, 100% will be covered. The explicit rules of a deposit insurance system may provide for insurance for all customers of a bank or only for retail customers and small businesses. Yeah, sometimes what it says is that can be applicable for all customers or only for the retail customers and the small businesses. But I think in Sri Lanka, it applies for all customers, right? There's no discrimination, no, that applicable for all investors, all depositors across the board, right?
All investors across the board.
Yeah. Right. Although bank deposit protection schemes give some degree of protection, its availability should not distract investors from assessing credit risk extremely carefully. Higher than normal returns may mean higher than normal risk. Yes, I think even though there is a bit or other insurance there, you should do your risk return analysis and identify the best banks or best financial institutions to park your money. So just because of you have the insurance, you should not forget that particular risk return analysis. Main types of money market instruments: cash deposits or repos. Money market deposits are fixed term deposits of up to 1 year with banks and securities houses and are all known as time deposits. They are not negotiable and so can't be liquidated before maturity. So I think the money market deposit that you mentioned, but that has the liquidity, there's no kind of a fixed time, no? So then here the cash deposits repos means here the money market deposits are fixed term deposits up to 1 year with banks and security houses. That means basically these money market maybe funds, yes, and are also known as time deposits. Yeah, this is, we are talking about time deposits, that means fixed deposits we are talking about here, right? So they are not negotiable and so can't be liquidated before maturity. Yeah, so then this is basically we are talking about here the fixed deposits, right? So that's one instrument in terms of the money markets up to 1 year. The repo is a sale and repurchase. Yeah, repo, as I said, you repo is a sale and repurchase agreement again, and is similar to secured loan. As I said, one company want to raise some funds or borrow on top of the securities available, or in other words, treasury bills or bonds typically. You place to the lending party, and the lending party will provide the loan. After that period, maybe 6 months or 1 year, again repayment will be done, and the securities are transferred to here. So then lending will be provided, or rather borrowing will be done up to a certain percentage agreed on top of that total value of the security. Say so total value of the security is 100. So then you will not be lend the entire 100. So then out of that, 75% will be lent. So the borrower can borrow 75% of the value of that particular securities which is going to be pledged. So that's a repo agreement. So typically a repo enables holder of securities to obtain funding against the securities as collateral, and for the lender of cash to obtain high quality collateral against a loan. But typically in Sri Lankan context, these finance companies are engaging with these repo transactions where the treasury bills are the other typical instruments where you pledged. So this puts vital liquidity into the market, right? So then these are sort of a money market instruments. One is your cash deposit, or the cash deposit in terms of the time deposits or fixed deposits up to 1 year. And then repo is also there, because repo is also a short-term transactions up to 1 year. Treasury bills. Yeah, treasury bill is also a money market instrument where in Sri Lanka you can see 3 months, 6 months and 1 year periods issued by the government at a discount, as I said, which is issued at a discount in a sense. So nominal value, say 100 million, right? So then you invest 80 million, right? So that's a discount. Okay, 20% discount, right? 80 million. But at the maturity after 1 year or a 6 month, you will be getting that 100, right? So then you invest at a discount and you get the face value at the end of the maturity period. That's why we call it as these instruments are issued at a discount and redeemed at nominal value. Then at the maturity, you will get the 100 entire nominal value. Tenor is generally 3 to 6 to 9 or 12 months period. In Sri Lankan context, 3 months, 6 months, and 12 months. Highly liquid and is the benchmark for the risk-free rate. Yes, this is sort of a risk-free rate. Why it is called risk-free? Because there's no default risk. But of course, that's a question mark.
They think they can print and give money, but ultimately it's not the case for every country like us.
Yeah, that's the thing. That's the assumption where they can print money because the sole authority. That's what we have been experiencing. That's why we call it as risk-free.
Yeah.
But due to this risk-free, there is a underlying, economic impact to the country and as a nation that we have been, suffering, right?
Yes.
So yes, so typically this is called risk-free. So due to the zero default risk benchmark rate to price other instruments. Yes, so this will be used to price the other instruments. On top of that only, you will adjust the risk component and arrive at the return. Because if you look at the securitized papers, commercial papers, all these instruments are priced based on the treasury bill rate or the 1 year rates. Then I'm assuming if you are going to issue a 1 year commercial paper, so your benchmark rate would be 1 year treasury bill rate and top of the spread based on the credit rating that you enjoy, credit rating that you obtain, right? So likewise only you will be price your instrument. Investors also think about that way. Why should I put into your instruments which carries say 18%? So I'll be telling you 1 year treasury bill rate is I'm getting 16.9%. So why not put in there at a zero risk? And for the risk I'm taking for me to invest into your instrument, I'll be getting only 2% extra. So that's not worth. So then likewise, investors think in that way, that compare with the risk-free rate or the treasury bill rate. So that's how the pricing will happen in the other instruments like securitized papers, also same thing, right? When it comes to securitized papers, the required rate of return from the investor's point of view, so they first look at it. What is, if I put in a treasury bill, what is the rate I'm getting? Okay, so then you add on your risk premiums. You take your credit rating and then you add on your risk premiums to that thing, and end of the day you come up with this is my required rate of return. So even if you look at equity valuations too, you are talking about when you calculate your cost of equity or your from equity investors point of view required rate of return, you benchmark your treasury bill rate or of the treasury bill, and that's technically it has to be a longer term bond, treasury bond, but usually we take the 1 year treasury bill rate as well. So on top of that, we add the market risk premium and get the required rate of return, or in other words, cost of equity. So likewise for any pricing of your instruments, this has become a sort of a benchmark, risk-free rate, right? Used as a monetary instrument to absorb excess liquidity in the market. Yeah, so then if you look at basically, say you have a central bank also invested in the treasury bill. So then say assuming if central bank issue more treasury bill to the market means, so then if you invest more in the treasury bills, your liquidity, the market liquidity will drop down and the rupee will go to the central bank side. So then if central bank want to cut down the market liquidity, they issue more treasury bills, right? So if you want to say pump money, so then they can do the reverse side. So now they have the treasury bill holdings also. Sometimes those treasury bill holdings from the treasury bills and bond holdings, they sell those stuff to the markets. Then market or other banks and other sort of institutions or primary dealers invest there. Then what happens is liquidity goes out of the system to the central bank. So then your money supply will go down, right? So then this is the kind of a way where this is a kind of a method where central bank use it to absorb or add liquidity to the market. So basically they absorb the excess liquidity in the market and sort of a money market instruments or a monetary instrument as well, monetary policy instruments as well, treasury bill.
So these
Certificate.
treasury bills are called risk-free instruments, no? Treasury bill.
Sorry,
Treasury bills are called risk-free, no?
you mean to say risk-free?
Yeah, investments.
Yeah. So then
Yeah.
that's what I think.
Gilt edge, and they call it. But so now in a situation, the present situation, if they are going to have these haircuts, we say it happens, then you can't call it a risk-free instrument, no?
Exactly, yes. Because but typically, that's the norm, right? The government has that printing facility or the printing capability, so that's where the default risk is free. That's what we consider. But you are correct. You are very much true in this sort of situation where if there is a haircut happen here, then you
So
can't.
actually, people don't know that there's a huge risk in investment in these government bonds and securities. No? Some people.
Yeah, not people, even the banks. Banks are under tremendous pressure if they're going to haircut the treasury bills too.
Sorry,
Even
I
banks.
didn't get you. Sorry, I didn't hear you properly. Sorry, I didn't hear you. Please go ahead. I think Prasad was speaking, right?
Yeah. I was taking the point he said. Even the banks, they have tremendous exposure. So if the haircut is going treasury bills, they are also in trouble. Not the people, but ultimately people will suffer. Everybody.
Exactly. Now, this is where the whole uncertainty is. What will happen tomorrow? If there is substantial impact on the banking sector, then I would say, because if you look at the current day, capital buffer is also eroded, right? For you to grow, run your business or other banking business, so you need to be recapitalized as well as some of the banks. That requirement also comes. But who's going to capitalize? Who's going to invest at this stage? It's also a problem. So then tomorrow is going to be very crucial day, I guess, what happened to the banking sector. But I
So
don't
even the
think.
foreign investors will be skeptical on coming to invest in Sri Lanka now, if that happens.
Yeah, that's the
There
thing.
won't be foreign flow of funds there won't be foreign flow.
Exactly.
We
No,
are expecting this to come in. No? So if there's a huge risk in the banks, how are they going to invest here?
If you look at, I'll tell you a story, because we were talking about few foreign funds in terms of the bank recapitalization, right? So the issue that they were having is they don't want to look at banks right now due to this kind of a debt restructuring, especially the foreign debt restructuring and the domestic debt restructuring. Both are affected to the banks. Because if you look at the banks, like, no, I don't want to quote the names, but if you look at the top few banks are having relatively high exposure to the USD bonds as well, sovereign bonds, and the Sri Lankan development bonds in the dollar denominator. Those are also subjected to haircuts. No, those are with maybe 30-40% haircuts. Then that will affect the banks in that context. So, but not the old banks, but some of the big banks are having some high exposures. And when it comes to domestic debt restructuring across the board, yes, all banks are having exposure to treasury bills and bonds. Because treasury bills, especially, that's your liquid asset ratios, how to maintain mainly from the treasury bills, right? So that impact is also there. So in that context, they wanted, these funds wanted to wait till this DDR and other announcements happen and see how the impact happened to the banks. Because sometimes if your capital is going to be eroded sharply on that thing, then they are,
they will not come.
Yeah, they will not be willing to take the exposure right now, with these volatilities come across. So they have a wait and see approach with this DDR and other sort of a restructuring plans across. So then, of course, they might see this is how the valuation or other impact on the capital, and then they decide what the valuations, if they want to bring into the table. But the problem is at that valuation, if the banks are valued, and if you want to raise funds to meet up your capital requirements, the percentage kind of a share stake to be offered would be higher then, right? So that's the issue. So then all funds are a bit waiting. till to see how DDR and other instruction affect the things are affecting the bank.
So
I
as
think
per the top management promise, they won't touch the treasury bills. They will only restructure the treasury bonds.
Okay,
For sure.
that's what your management's perception, right? Okay. Yeah, I think that's what.
Regulator forbearance as well.
Sorry.
There will be regulatory forbearance as well. They will flex the rules like capital adequacy and other things. If there are any impact on the banks.
Yeah, they probably will relax those things. Maybe otherwise that will be a big issue. No, that is also there. But yeah, that's the news we also got earlier. With the treasury bill will not be touched upon, but thereafter few sort of who's saying that should also be will also be touched. So then there's the issue. But thing is, this DDR issue is no one knows. This is the area where we had the lowest clarity, I guess. So even to the as at today, no one really doesn't know what will really happen to them. So hopefully, yes, my guess also will not have a big impact on the banks, especially amid this scenario. Then that will create another sort of crisis, but I don't think that will be happen here because
I think so. We can get an idea about it if we analyze what percentage of the whole debt that government has issued in treasury bills and bonds more than 1 year. Then if the bond percentage is lower than short-term treasury bills, so definitely what now they are doing is not going to affect unless it will affect for short term. So if they unless come up with a plan, they have to go for the treasury bills also. I think for now they will take the action like that, but we cannot say it's not sure how things go.
yeah.
We don't know what the expectations and how that will affect. The
Yeah.
expectations should be, the expectations are somehow delaying their payments and somehow carrying this through, no? Whatever. So if they are talking about only bonds, or maybe some treasury bills, selective treasury bills, like you said, sir. So we have to see what proportion they're going to restructure. Then we can see what's going to happen.
Exactly. I think, as you pointed out, the proportion of treasury bills and bonds, I would say the treasury bills are also quite substantial. That's my guess. I think that's what I heard.
Yeah.
So in that context, there would be some impact on the bills as well. That is, yeah, let's see. Fingers crossed. Yeah, so coming back to the certificate of deposits. Guys, now just want to understand, so certificate of deposits in Sri Lankan context, which is like a fixed deposit, but there's no sort of a liquidity issue. If you want to get the money, you can get it money, and the particular interest rate will be paid on for that particular period. That's what I heard. So what is the real certificate of deposits in Sri Lankan context? Any idea? අපි කියන්නේ මොකද්ද මේ තැම්පතු සහතික කියලා කියන්නේ නේ?
I think the in banks they are called call deposits. I think they need
yeah, call deposits.
Call deposit. They need 7-day prior notice before withdrawal. I'm not sure about the threshold amounts and rates
but
are low.
call deposits are pretty much a very low.
Very low instrument, yeah.
Very low, no?
interest rate. Yeah, very low now.
So I think this CDs are long term. It's a call deposits only 7 days.
7 days. Yeah.
Deposits are long term, no, 5 years. So I don't think you can you can only, there's no name, I think. That's the difference. You can give it to somebody, but you have to
So
wait.
bills for fixed deposits, it carries my name, no? Right? So for certificate of deposits, you mean to say there's no name mentioned there, right? And it can be freely transferable.
So I
Are
think
they
most of the
available? Are they
banks,
available at banks? That those
most of the
CDs?
banks, they don't offer CDs due to the risk
Yeah.
of
Hmm.
CDD and financial crime.
Right, because in the bearer in nature, no? Right. Yeah, let's see now. Yeah, it is negotiable bearer security. Yes, as you all mentioned, there's no, kind of a registered name as such. It's a bearable nature and the negotiable one. And issued by commercial bank for fixed term deposits. So that means around sort of a maybe fixed term 5 year or whatever that period. Fixed term and a fixed rate of interest set marginally below that of an equivalent bank time deposits. Also that basically for a time deposit or fixed deposits compared to fixed deposits set marginally below and carry a fixed rate interest, then this is also more of a time deposit or a fixed deposit, but without the registered name or in a bearable nature. And bearer can hold to maturity or liquidate in the money market. All right, so the bearer can hold up to the maturity, or he can, sell in the money market to another, maybe an investor, right? And can be issued with a term of 5 years, right? So these are the characteristics of a Sri Lankan context too. I think yes, no, as you all said.
Because I don't know whether it's tradable in the market.
Okay.
But it's transferable. You can give to somebody else. There's no name now, so and at a discount you can get it.
Right. Okay.
Say somebody wants some money urgently against that, so you will not get the full benefit. Maybe at a discount you have to give it to the other person.
Okay. There are also an important means by which banks can borrow or lend reserves between themselves. Since they are a fixed interest security, the price will fluctuate with the competitiveness of the interest rate compared to the prevailing yields. So then that means in this case, that is basically tradable, right? So then in the money market, if you want to basically sell to another investor, you can sell it, right? That depends on the price will depends on the interest rate changes, right? Whether the high interest rates they are, so then your price will be lower, and then you will be selling in the money market at a lower price, right? So then investor, whoever who buys it, will be getting that sort of a high interest yield, or the yield will be higher then, right? Yeah, thus exposing holders to potential capital gains or losses, right? So then this is tradable. This can, the price may change due to the interest rate changes. I'll explain that in more detail with the bond discussion. Then we can discuss that how the interest rate changes happen and how that will affect the pricing or the value of the bond. The same scenario will affect the certificate of deposits as well, exposing holders to potential capital gains or losses if they sell before the stated maturity date.
There's no accepted market for this. You have to just find a buyer, to somebody who wants to.
Yeah, exactly. Now, if you look at a bond, actually, those are listed then through an exchange.
That's right. Yeah.
Easily price it and, sell it, right? But those things, yeah, it's very, illiquid market. I guess there's no, there's a private
Yes.
market. Even if you look at the, as I said to you, these commercial papers and securitized papers too, they can sold discount and you can sell it in the, but in the private market. So then it's a one-to-one. You have to go and discuss with your potential investors and try to do that thing, right?
That's
There's
right.
no exchange there. So not easy actually.
Not easy. But then it's good as cash.
Exactly.
It's cash. Yeah, it's a certificate of deposit cash.
Yeah. So again, main types of deposits, yes, commercial paper. As we discussed, unsecured negotiable bearer instruments. Again, it's a bearer securities, right? Or short-term promissory notes. Promissory note is also sort of a commercial paper where you promise to pay in a given period. and you borrow, that are issued by companies with a full stock market listing. So in this case, in Sri Lankan context, commercial papers, yes, you can issue from the private companies as well, right? Because these are in private markets only, you will be invest in these things, right? 1 minute. Yeah, so then that are issued by companies with full of stock market listings. So then in Sri Lankan context, bit of a difference. The private companies can also raise depending on the credit rating. And here in this context is stock market listed entities are issued at a discount to par. As I said, yes, you issued at a discount, so you invest the discounted value, but after the maturity, you'll be getting the total value or the nominal value, right? Discounted par, and the US have maturities of up to 270 days, but with an average of around 30 days. Yeah, so then in US, the maturities are up to 270 days, and with an average of around 30 days, papers are there. So in Sri Lanka, whatever, it may be a 6 month, it's a private one, no? So it may be a 6 month or whatever period, 4 months to 8 months, whatever. Now, you mean, now we'll say if, if investment bank there, so a client come and tell, we'll say, assuming Janashakti come and tell, I need to raise 200 million with a 4 months maturity. So can you arrange something for me through a commercial paper? Right. So then investment bank will arrange with that, come up with a commercial paper, right? And start negotiating with certain investors, selective basis, go and, do the transaction and transfer the funds, right? It can be 4 months, whatever tenor within a, short period of time, less than 1 year.
So they say average of 30 days. Does that mean? That means only most of the commercial papers are only for 30 days.
In this context, yes, most of the commercial paper 30 days. That's what I said in Sri Lankan context. There's no hard and fast. It's the discussion between the investor and the borrower, right? It can be 6 months, it can be whatever period can be there. In Sri Lankan context also, it's mostly, I think, what I have seen is mostly 6 month papers are there, right? In a short term that you can borrow, but unsecured, right? They are corporate equivalent treasury bills. Yeah, government raise funds through a treasury bill for short term, 3 months to 6 months to 12 months. Similarly, if companies want to raise, I would say, short-term funds, they can issue a commercial paper. Again, that's maybe, with below 1 year, and issued at discount. Treasury bill also issued at discount and redeem at par. Commercial papers also redeem at issued at discount and redeem at par, right? So likewise, from a government side, there's a treasury bill, and on the corporate side, maybe a commercial paper. Equivalent kind of a characteristics, right? So with this, guys, today we will wind up the discussion. So then let's meet up this Thursday as well, because I missed the last class. So hope everyone can log on Thursday as well as usual. So then, yeah, we'll meet up coming Thursday.
Okay.
Any question? Any questions, guys? Or shall we wind off?
Yeah, we are.
Great. Good night. So then we'll meet up on Thursday.
Okay.
Thank
Good night.
you.
Good night, sir. Thank you.
Good night, sir.
Night.